There's always a bargain to be struck between potential and safety. If your goal is growth, then it behooves you to make sure that your equity is working as hard as it's safe to do.
Welcome into the Get Invested podcast, a podcast about all things real estate and real estate investing, brought to you by Capital Velocity Investments and a part of the Matthias Talks Investing Substack.
Hello, everybody. Welcome in here to another edition of the Get Invested podcast. As always, we're your hosts, Jordan and Matthias, and we're excited to be here to talk all things investing, real estate, and real estate investing. Today's topic is going to be a little more general, although our example is not going to be, but we're going to talk about a concept, a financial concept, or comparing two of them, I guess. ROI versus ROE, return on investment versus return on equity. My part in bringing this to the podcast was thinking we could talk about equity in general as a concept because it works differently in different scenarios. And it is, I feel like, a term that people throw around a lot that
has a bunch of different meanings depending on the context.
Yeah, and it doesn't necessarily, I don't know. I think it gets slippery and foggy for people just in general, like that it's not exactly the same every time. So that's how I contributed, I suppose, to this topic, but it was serendipitous because, as Matthias is about to tell you, he had just had a combo that worked right with this, which is how we got to this framing. So Matthias, I'm going to hand over to you to give us a breakdown of ROI versus ROE and, you know, why you were thinking about it. And we'll get into it.
Yeah. So kind of what Jordan's bringing up, the equity thing, jogged my memory for a conversation we were having in the old Wilson house just not even a week ago, because we're in refinance mode for our property, our little 8-unit that we own ourselves, no investors. So it's not investment related at all for anybody out there. This is just purely us. Basically, we're at the end of the term of the latest loan that we have on that property. And so we're talking refinance and discussing the potential of either just a straight refinance where you're just, rehacking on the loan and floating the interest rate as it is, or if you're, pulling capital from the refinance or what you're going to do. So we were having that discussion in the Wilson house, and that prompted me when Jordan said equity. I was like, oh, that's great, because the main calculus that goes into my mind when we're talking about should we pull cash and when we refinance, or should we, leave it as and keep the debt really low and make more cash per month without a higher loan payment. The big calculation that goes on in my mind as an investor is kind of the return on investment versus the return on equity. And basically, in a nutshell, what that means is, you may be getting a real good return on whatever amount of capital you have invested in a certain project, a property project, whatever you want to call it. But at a certain point, you may have so much equity built up in that property that it's almost a law of diminishing returns, that you have so much equity. That equity, if redeployed, could be doing a lot theoretically. And this is, we'll get into it, but let's just say the question is, could that equity be doing more for you if redeployed, if you were to pull that equity out of there, either from maybe a sale and just exit it because you've done all the work, or a refinance, pulling cash, keeping that at a obviously lesser cash flowing to you because there's a higher loan payment now because you pulled more capital. But in that scenario, you get to redeploy that, whatever that equity is that you pulled. So basically, that's the concept that we're going to be kind of discussing. We have some kind of ballpark numbers and some figures to throw at you, but the figures are less important than the concepts and just the understanding that there's a point where you got to start thinking return on equity versus return on whatever the return is that you're getting on the current project.
Right. Well, a few things just on the numbers. So we're going to anchor this conversation because if you've been listening to this podcast any length of time, you know that I really like to make sure we have some kind of concrete examples. But the example is to illustrate the concept. That concept does come back to a calculation, and that calculation includes potential. So it's not hard and fast for one, but a couple of things before we launch into that. This is just going to be a single investing entity, right? There's no distributions. This is just you. If you are personally, or your wife or your company is investing in one thing, or you are the one thing investing in it. So moving forward, so to just keep it simple.
Yeah, not to complicate it with a whole bunch of investors and a manager and all these different things. We're just going to talk to a straight concept.
Yes, return on that, whatever it is that this one single entity has invested. And then the other thing I think just to make sure that everybody's on the same page, this kind of calculation in what we're doing is investment only, right? It would be a different calculation if it was a bunch of equity in your own domicile.
Yes.
If it was your own house, that would be a completely different calculation. This is strictly you own a property that is an investment property that generates income. So, because that is honestly one of the reasons why we're talking about this today, is because I was thinking about the fact that that's the one kind of equity I think people probably are most familiar with.
Whatever equity they have in their home that they live in. Yeah.
So we're setting that one aside, and then we're going to go try to be straightforward with this calculation of ROI versus ROE in an example of an investment property.
Yeah, and I think it makes sense to cage it like that, because basically we're thinking only as investor. There are no other calculus. There's no personal, family, financial. We're just, hey, as an investor trying to maximize returns, that's my goal as whatever this investing entity is, me with a bunch of money, or like a company with a bunch of money or whatever. So removing all the other calculuses that would go in for any individual family or whatever per their own particular situation. So we're just focusing on the concept today, not necessarily financial advice or anything like that.
Right. This example and conversation is just about the concept of the two, ROI versus ROE, or another way of thinking about that is cash versus equity. Cash in a deal versus the equity in a deal. Okay.
So to set up the scenario here, that what we put together is basically, let's say that you found a little, we can even, it's very similar to Toller, the way that our little 8-unit works out. It's called Toller Properties. But let's say that it's very similar to that. There's a little 8-unit apartment complex that you can buy for $500,000. And you have $100,000 to put down on it. We're assuming super easy. There's no extra work, closing costs worked out to be zero or rolled into loan, whatever. So you buy this property with 20% down, $100K into the property, $400K worth of loans. So it equals the $500K property. Obviously, it's never going to work out exactly like that, but for our numbers' sake, we're going to do it this way.
Pretty high LTV too. So
yeah, 80%. Yeah. Well, for these days, for sure. Anyway, so in this scenario, we kind of did some real easy calculations, just things making roughly $35K a year of net operating income. So after all expenses are paid, it's making $35,000. Let's say in this scenario, our 100K is producing $35,000 a year. That's debt independent. So obviously some of that's going to debt servicing, probably most of it in this scenario. But that's beside the point. We're valuing it based on the NOI, just like we always do for commercial property. So let's say that over the course of the next 5, 10, however many years, whether the rents go up, expenses go down, what have you, location is booming, so rents are skyrocketing. Let's say that you're able to increase the NOI by another 35,000. So you get your NOI up to 70,000 per year, which effectively doubles the value of the property. So doubling the NOI, doubling the value of the property, assuming all, cap rate, assuming everything else is the same. So basically, over the course of X amount of time, the value of the property goes up from 500K to $1 million, roughly. So now it's worth $1 million. You have $100,000 of your money parked in there. You only owe $400,000 on it. Let's say it was an interest-only loan for the whole time. Again, just for ease of calculations. $100,000 of your cash you put in, $400,000 worth of loan, and now you have another $500,000 worth of equity sitting in the property. So total, you could, if you sold today, you'd pay off your $400K loan, you'd walk with $600K cash, obviously before taxes and all that. So we're going to discuss what the calculus is going on to deciding what to do at that point in time, if that makes sense.
Yes. So just to bring it in, what we are going to discuss is at that point, that decision, this is kind of inflection point, if you will. We're assuming that this is before the life of the loan. It's up. Yeah.
Maybe it's coming up and we're deciding what to do, kind of in the same situation that Jen and I are in.
That Toller is right. Exactly. So the calculation is based on the fact that you do have $100,000 invested. Mm-hmm. And then you have a valuation that has produced 500,000 more in the value of the property. the one thing I want to say before I flip it back to you is that one of the main parts of this calculation is the potential, because that's 500,000 potential dollars. Right now it's on paper, it's 500,000 potential dollars. And we're assuming that you buy and sell at the same cap rate. Basically, you're getting the same amount of money for the income that you purchased the income for.
Right. The same rate of return. Yeah, exactly.
And then of course, the other part of this is, what if you do this, what could that money be doing elsewhere?
Right. So when you're talking return on equity, just like Jordan says, you got to talk opportunity cost. So maybe I am, maybe I'm not, missing out on potential compounding returns by leaving this cash in here? I guess we can do a little bit more math here. So now theoretically, we have $600,000 sitting in a property producing $70,000 a year. Now, at the beginning, we had $100,000 producing $35,000. So Jordan put it in before the mic's hot. Basically, we were talking about, like, the real calculus is you have 100,000 producing 35K, and then you have 500,000 producing 35K. That tells you that more than likely you are sacrificing some opportunity cost in the current scenario, right? So your money isn't working as hard as it potentially could be.
Exactly. Because it's, first of all, it would be amazing if you doubled an NOI of a property. Not outside the bounds of possibility.
No, not unreasonable. It
Definitely
takes time.
Possible, but you would be very happy with your investment.
Right.
There would be no griping about this particular property.
Yes. Fewer fights. Agreed.
Yeah, that's right. So that's awesome. And everybody would be pumped that's involved, and your friends and everyone would be like, man, that's incredible. But like Matthias said, it is awesome, but you also could calculate it as, if you look at it as, why I had 100,000 making 35, and now I have 600,000 making 70. Those percentages
not as great.
Return are not as great, because again, you're talking about what could that amount of money be doing somewhere else. And I don't want to jump ahead, but it's not just necessarily, oh, I could take all of this money and do something else with it. It's, I could still have this investment and also have another investment.
Right. So the apartment guy in me looks at this scenario and goes, so I've got $100,000 that it took, and obviously this is all market dependent and everything, but let's say that in this awesome land we live in, where, you know, you can double things over a few years and the interest rates never change and all that stuff. But basically, you look at your property and you go, okay, it took $100,000 to get a 500K property. Over time, it became worth much more, and it cash flowed. So I look at the case in point and I go, okay, so we bought the property with 80% loan to value. We were okay with that, right? We were okay with that margin because we bought it. So let's go back. What if we went back to an 80% loan to value, and we would pull what? We'd pull 400,000.
Yeah,
right?
I mean, if you want to leave it at 20%, right? So you'd leave 200,000 in on $1 million valuation.
There we go. So 20% in the property or down payment. Think of it as another down payment. We're pulling 400,000. I go buy 4 more properties with 100K down, and you know what I'm saying? So now that, and let's say that they're all similar scenarios. So they both, all those $100,000 are now producing 35K on their own again, right? So now we're looking at,
I mean, I think you
35 times 4,
temper it and say like
150,
20, and someone make 32, and it's still going to be okay.
On average, we're going to be doing pretty well. So now the cash flow is skyrocketing because we have tapped that potential, and we're, you know, in addition to our 70K we're making on the one property, and obviously we're talking net income. So you're not going to be netting 70K after you refinance and pull a whole bunch of capital. You're going to be, I mean, cash flow wise, you're not, it's not going to be coming to you because you're going to pay a lot more in debt coverage. But the potential is there. And in the general, like, we can ignore debt coverage in this scenario because we're talking about the concept. Obviously, these numbers all need to be run every time this type of calculation has, like, hey, what's the new payment going to be? You know, and then what would it be on the new properties, and so on and so forth. But in general, this is a calculation that needs to happen. So my answer as an investor is always going to be my maximizing the potential of every dollar of equity I have in a property. Kind of the other side to this concept is, well, we love margin, right? I'm a risk averse dude. Everybody doesn't believe me when I say that, but let's say this scenario happens, you pull all that equity and then the market tanks in terms of, let's say the big businesses in this town where this property is closed down, everybody moves out. Now you owe $800K on this thing that's only worth $700K. So now you're in a potential underwater situation. That's a really, really bad, tough scenario. That's, kind of end of the world type scenario. But that's the other end of the calculus in terms of how much do we pull. It's like, hey, how much risk are we willing to accept in order to keep this stuff moving, keeping our equity working for us as hard as it could.
Yeah. So in that scenario, if we're going to go kind of back and forth, again, as we've said, these calculations, there's numbers, but then there's also the potential, and that potential could be bad as well, negative and positive. Potential is a neutral concept in this instance. So you could say, okay, well, why don't you just walk down the middle there, pull 200,000, right, and then buy just 2 properties, or maybe just buy one at a higher down payment.
Yeah, now your whole portfolio has less leverage and more safety.
Exactly. But you've also got 2 properties.
Yeah, and the same that second property has the potential to grow in value, just like the first property does, and the first property can continue as well. So exactly right, and that's the kind of give and take, push and pull, find a middle ground, because rarely is the answer do nothing, and rarely is the answer do the absolute max. It's always going to be somewhere in the middle, right? So finding that balance between, hey, there's 400,000 sitting here. Let's pull 200 of it, or pull 150 of it, pull 300 of it, whatever, exactly whatever makes sense, in order to avoid missing out on the opportunity cost, but also to avoid overextending and leveraging to the hilt to where you're now in a higher risk scenario.
Yeah, and I guess we should make it clear that in the scenario that we're trying to use to illustrate, this is clearly a refinance, not an exit, right? Because the goal in this scenario is to compound investments, that you make one investment into 2 or 3, rather than, okay, I made all the money on this one, now let me go buy a new one. Now that's also a possibility, because then you
could do that.
Say in this wonderful land this example lives in, if you walk with 600,000, of course, if everything holds,
you could get 6
theoretically
instead of exactly. So
you can purchase a $3 million property, and then the same thing goes. But I did want to say just briefly, I know we're not talking about debt service, but for anybody who is like, well, I mean, that's kind of one of the big calculations. You just said you could be over leveraged. Yes. So for instance, let's make it simple. Let's actually go with a pretty standard interest rate right now, which would be like 7%. A lot of this is based on a 7% thing. It's just kind of how it happened. It's working out beautifully. We're going to stick with it. If you have a 7% loan on $400,000, that's $28,000 a year, roughly.
Interest only.
Interest only. IO, yes. Which again is a great scenario, but not an unrealistic one. So, so you're clearing 7,000.
After debt service, you're at 35,000 minus the 28 equals 7. 28. Yep. On your $100,000.
Right.
Not terrible.
So that's a 7%
cash on cash return.
Cash on cash return. Absolutely. And then in this scenario, if you refinance to 8, and again, the interest rate magically is still 7.
It's the exact same. It's beautiful.
And I think that's okay, because theoretically it could go down, or theoretically it could go up. So it could be better or worse.
Averaging. Yep. Yeah. It's floating rate and it averages 7.
It's averaging 7. You're going to be paying twice that. So you grew your net income before you refinance was actually 42, because you added 35 to the NOI and you kept the same debt service. Right. So if you refinance and you go back up, and your net is going to be 14, because you're going to, if everything stays equal,
for that property, while your other
is 56 out of 70. Right. Yeah. So I bring that up just to say that would be one of the calculations, because if you decide, okay, I'm not going to take $1 million loan to refinance, I'm only going to pull out, a smaller amount, then yeah, you're not going to be able to go invest in as many other places, or, you have less to go, but you also will have kept more net income, not NOI, but actual just net income
for property numero one.
Yeah.
Yep.
Numero uno. Right. So I just wanted to make that clear, because it's not outrageous. Skipping debt service doesn't mean like, they could possibly just be losing money and still their NOI is 35,000. Like, yes, theoretically that is possible, but also even with a not so great interest rate of 7%, there's still money there, I guess is my point.
Yeah. And that's a great segue into kind of the next stage of our discussion, which is back to the term, the potential. So typically, if you buy a property, it's hard to buy a property at a big enough discount to double it and then keep growing it at as rapidly a rate.
You've squeezed that grade.
Right. And we are known as value add investors, meaning we identify a discount in the market due to problems. We fix the problems and we, hopefully we double the value. I mean, we've come close on some properties before, but in terms of doubling NOI and whatnot. So it's easier to buy non-performing assets, fix them up, improve, create that equity via increasing NOI. There again, we're back to the law of diminishing returns, right? Like at a certain point, you've kind of hit the market rate, and now you're only appreciating theoretically at the market rate of appreciation as rent goes, maybe 2-3% a year versus your 10, 15, 20% a year. Double it, to double in 5 years is 20% increase, right? So 20% increase each year for 5 years in terms of net income, for instance. So that's hard to maintain unless you live on an island and there's only one hut and there's more people arriving to the island all the time. So you can just keep charging higher and higher rate. Otherwise it's at some point it's going to balance out. Yep. So that's the potential we're talking about. Your potential for growth diminishes over time on property numero uno in this scenario, because you've theoretically tapped all you can do. You fixed all the problems, and now it's stabilized, and it's going to, over time, it'll gradually increase in value, but not nearly at the rate that you've been working at. So now you look at those potential 3 or 4 other properties. Now you're looking at, well, I could leave it in here and I know I'm going to make whatever it happens to be the net income.
If you had not refinanced at all, it was 42.
So I could keep making my 42K, but I could also turn 7K into 42K on 4 other properties over the next 5 years, theoretically, by refinancing, pulling 400K and moving on and executing the early stage of the business plan again and again. That, in a nutshell, is the compounding beauty of the value add plan, is that you can add the value, create that equity, pull the equity, move it to the next one, do it again. That's the compounding potential that goes with real estate investing. And again, it's never a given. It requires work. But if you, like, for instance, me, this is my philosophy because I know I can do it. Been doing it for many years, and it's life-changing when you can stick with it and pull it off like this. So the potential is a lot more attainable if you know what you're doing, and it's something you're good at. And something we talked about before the episode. Give us your stock analogy that you were working through when we were discussing this, just as a way to cage it and kind of analogize it a little bit differently.
Right,
kind of the same concept.
The analogy is the downside and beauty of analogies is that they eventually break down, but a lot of times in that breakdown, there's something else to be learned. Sorry to go all English professor on you guys for a second, but so I was thinking about it, and it's a lot like you invested in a growth stock. I'm not even going to name a company because that'll just make it murky, but you invest in a growth stock. That stock increases in value because the company is a good company. And then eventually that stock's price stabilizes as much as stock prices do. It comes up to another price point or value point and basically remains there. And over time, theoretically, growth stocks turn into value or dividend stocks because they have reached
a market capture. They've built their moat, and now
they do a thing well. They got a good moat. They've got a good plan. They've captured as much of the market. Of course, they're always going to be looking to generate
grow,
more,
keep growing,
generate and
obviously.
grow, but it's not going to be the same. Again, same thing.
Meteoric.
Ability.
Yeah.
It's not going to be meteoric. Yes. So this
You
scenario,
picked in this scenario, you picked a penny stock. You know, you bought it for like $72 or 72 cents a share, and it hit
right
$120.
It's like that thing, like you turn 10,000 into $1 million because you bought 10,000 of I don't know, Amazon in 2001, or whatever, and now right, same thing. So at that point, you could look at it as the amount of money that stock is worth now, subtracted from the original outlay, is equity, and the same calculations apply. So you could take some of that money. Of course, you have to sell stock to do it, but you're now getting way more per stock, obviously. So you can maintain a position that drives dividend revenue, or not revenue, income, sorry, depending on who owns this, but drives income, and take that equity, some of that equity, and buy a new growth stock. And then that stock, you know, if everything works out, of course, does the same thing, increase in value. And that's kind of the same thing as what we're talking about, where you maintain a position, but you use the value that investment has created to at least double your investment opportunities or outlets or whatever you want to call them. I mean, Matthias is over here telling you to quadruple, but in this scenario, but you could choose anywhere within that range, because obviously in this scenario, you wouldn't want to say, okay, well, say like the 10,000 to $1 million. You're not going to pull 990,000 from the growth stock or the now value stock to go Amazon, to the next growth stock, because then you won't be making any money on the value stock. So the same kind of calculation applies, but at some point, you leaving it in there, there's a very good chance that you have the potential to grow the investment with a new stock than the amount of money that will be driven by the dividend. I mean, very, very good chance.
Yeah, realistically, it's a question of risk, right? So, you know, the penny stocks are by nature extremely risky. You may never make anything. They may go kaput. They're nothing.
Yeah, in this scenario, when you definitely want to pull and then go into like 10 of them.
Exactly.
Because think about it, if you did 10 to $1 million, you've got a lot of $10,000 allotments you can put a lot of different places.
Exactly. And so you're spreading out your risk and you're managing it, because there's theoretically, if Amazon, and again, there's always single company risk, you know, the CEO goes nuts, or, you know, who knows, but
or has the longest midlife crisis of all time. Never mind. Sorry. Who are we talking about?
So, you know, that risk aside, but okay, we've got a stabilized value stock now. That is, you know, it's on the S&P 500. It's got a big name, for everybody knows who it is. The whole world's looking at it. So it's relatively stable compared to your penny stocks, right? So theoretically, the risk is a lot lower. Well, obviously the risk is higher over here, but that's where you make the money, is in the high risk. And the same when you're buying a property in a value add scenario, you're accepting the risk of a non-performing asset, fixing it up, and moving on. So basically, you're managing your risk, because just like in a stabilized performing property, hey, you know, we're and with a lot of equity cushion in there in case the market tanks. Okay, then you're relatively no risk to where you're sitting, but same is your potential for compounding returns is relatively low potential for compounding returns, because you're stabilized. So pulling funds theoretically from a stabilized investment back to a higher risk investment, that's effectively what we're doing with these scenarios that we're talking about, is we're moving low risk dollars to high risk dollars with the goal of having those dollars pay us for the risk we're accepting.
Would you characterize the scenarios moving back over to just for a second, the property side?
Mm-hmm.
Would you characterize moving to a new property a high risk or medium risk?
Higher risk. Higher risk.
Okay.
To buying a non-performing property.
Yeah, as a higher risk than leaving it in the
and it's the same for buying. Let's say you had $200,000, you're going to buy a higher risk property, a non-performing property worth less, or you're going to buy a performing stabilized property worth more. your return is going to be far lower on the stabilized property because they're going to demand a higher price. It's stabilized, it's lower risk. So
Yeah.
the riskier
Sure,
property
you're
can't
paying
demand the same.
for the lack
All
of
else
risk.
being equal, it's it's going to be, you're going to pay less for the higher risk property and therefore receive higher returns for your dollar.
Right.
That's the nature of
Mhm.
any type of investing. Really, is the higher the risk, the higher the reward, and just the whole goal is to build systems that allow you to take advantage of those risks better and to manage those risks better than the next guy, and so you
And to
create
hedge.
outsized returns. Yeah.
Yeah. To hedge risk. So you say people don't necessarily believe you when you say you're risk averse. I think that's because that term makes it seem like you just don't ever want to take any risk, but that's not what you mean. Right. Yeah. It's that you want to take risk, but you want to do a thing that has risk, but at the lowest amount possible for that.
I'm obsessed with controlling risk,
Yeah,
controlling,
controlling risk.
understanding, and mitigating risk, all the risks that I can. That's so I like to take risks, but I only like to take risks that I understand and have mitigated. You know what I mean?
Right.
So thus the markets that we buy in, the business plan that we've proven over time and all that. That's working with the property managers and partners. All those things are outside risks that I love to control because that allows me to, all else being equal, buy at the same risk level as everybody else. But I've knocked out 5 or 6 other risks that everybody has to deal with that I've controlled for in the systems and the processes that we do. And now I can achieve those returns with theoretically less risk because I've built the system that controls the risk for us.
Right. And then going back to our original scenario, you are spreading it out. Because to just kind of, I guess, tie a bow on the stock analogy, if you do the 10 to a million, which obviously is like super ideal, but it's just an easy way to get into it. Again, I will stress that valuation at $1 million of that stock is also only potential unless you sell it. And the equity, the ROI versus ROE applies, right? Because again, you're making whatever that dividend is, that's what you're making on the 10,000. So that looks pretty good. But then if you look at that dividend on the 1 million, right, what is it? And then how much?
Pennies.
And if for some reason the market has some tribulation, some vicissitudes as it often does. Yeah. And it comes down. Yeah, sure, it'll go back up. Probably if it's a good company. But that's an opportunity risk. You've missed the opportunity to have diversified into all these others with money that has been value that is created, that you may converted into money and then into potential value. And of course, if you leave some in that, a lot in that, and then you spread it around all these others, if some of them go bad, you still have, right? So I say all that just to think, I think some people would say, well, I have $1 million here, but if I pull out, I don't know, 300,000 and put in all these others and all of them tank, then I don't have $1 million anymore. It's like, well, yes, if you made just like, I don't know, 10 bad investments in a row,
you're bad stock picker.
Yeah.
Yeah.
But at the same time, you don't really have that $1 million.
Because it's really $1 million until you sell. Correct.
Yeah. And you are now maximizing the potential of creating more value in these other scenarios. So let's move on back, I guess, as we wrap it up here in a minute, to the property one. I guess if we want to put some numbers on it another way, if you did, like, say you pulled it out, right?
Mm-hmm.
You've got 42. You're like, oh, I have a steady 42,000. It's not going to fluctuate. The value's not going to fluctuate like a stock. That's what I have. And if I move to another property, it's going to be, the debt service is going to reduce this to 14. And then I'm making 7 on these others. You just got to do the math at that point. And then how much do you think it's going to go up? Because if even 2 of those other properties you could bring from the original 7, let's just say you buy 2 properties and you get one of them to 42.
Yeah.
Well, then you're making more than you were with just the one property right there. Even if the other one is like kind of just where you had it from the beginning. You have 3 properties. Yeah. You have 3 properties, one struggling, one you've stabilized, and one is on its way up. You're still making more than you would have if you just held on to the 42. I'm not going to go into like you buy 4 more. I mean, that's obviously that's
Start doing some math and some. Yeah. But I think we've done a decent job of explaining the concept of, hey, there's always a bargain to be struck between potential and I don't know, safety in terms of low risk from the stabilized. But at a certain point, if your goal is preservation, then by all means stay as safe as possible, right? Like stay in the stabilized property. But if your goal is growth, then it behooves you to make sure that your equity is working as hard as it possibly can, or as it's safe to do. And as you grow, your margins can get wider. You can afford, because you're growing, you can afford to give yourself a better, in the beginning you might be really risky just to pull everything, max everything in order to get some of those outsized returns quickly. And then over time, as you accomplish that growth, you kind of pull the throttles back a little bit and you say, all right, well, I'm going to give myself, instead of 80% loan to value, I'm going to start doing 75 or 70% loan to value on my loans, giving myself more risk mitigation factor, more margin, because I don't need to grow as fast now. So now I can pump the brakes a little bit and accept less risk to accomplish generally the same thing. I don't need to grow as fast all the time.
Right. And you're now in a situation where you can basically spend the money to buy more of a sure thing, right? That's what it is. Risk is free in a way, right? Like what you buy is the risk reduction. So, right. Sure. Yeah. So you could go everywhere from, I only pull the cash that I put into it, to like the scenario we've been talking about, that at some point, you can adjust and become that value dividend stock, I suppose, of the analogy. All right. Well, we're going to wrap it up there. Hope you guys got some out of that. I thought it was interesting to talk about potential. I mean, because it's one of those things where like the human mind kind of you got to hold on to like 2 or 3 things, and the fact that they could be changing all at the same time. So it's real fun to work through it and talk some numbers. We hope you guys enjoyed that. If you guys have any questions or thoughts or comments or critiques, as always, feel free to reach out. You can comment on any of the platforms this is on. You can email us at capitalvelocityinvestments.com with our first name, DM us, LinkedIn, all the places. Other than that, we're going to go ahead and shut it down for this week. And we hope that you guys come back and hang out with us again next week on another edition of the Get Invested podcast.
See ya.